stock earnings and favorite pastime.
So let me just say,
Wall Street
is
2.5x
because their compensation goes up.
Wall Street's wrong again.
Welcome everybody to this episode of Altimetry Authority. As always, I'm Rob Spivey, the Director of Research of Altimetry. We've got Professor Joel Litman, our Chief Investment Officer, and we've actually got a special guest today. We wanted to talk about something interesting. Dave Daglio, who's been a long friend of the firm, and has, Joel, I'll let you introduce him because I can't even remember all, Dave, your accolades.
Sure. So Dave, thanks for joining us, man. Really.
Great to be here. Great to be here.
And for those of you that don't know, Dave Daglio was CIO of, at one point, BNY Mellon. And that was when they were at the time the 8th or 7th biggest money manager in the world, running $2 trillion. Dave was on the board of the equities group that managed $500 billion of equities. Dave personally was actively managing $50 billion of equities. And over the course of his career, which started at Dreyfus, and then Boston Company, and then BNY Mellon, right? As it grew and grew and grew where you were, and Dave kept moving to CIO positions of bigger and bigger money groups, right? And during that time, he was Fortune Magazine's top 20 money manager of the year. He was Lipper Manager of the Year multiple times, Institutional Investor Magazine a couple of times, Asia Manager of the Year. I mean, you're running global equity, so you hit everything. So it's wonderful to have you on board and have you, speaking with Altimetry on the Altimetry Authority show. And we got a bunch of questions that I think people want to hear.
Yeah, look, it's a pleasure to be here. I am a customer and a user. Joel, I was thinking about today, and I was going back to when we first met, and I think it was 25 years ago, and I had a full head of hair at that point, and what I was looking for in my process was really, so I had tens of thousands of securities I had to take and boil them down to the 50, 60, 100 we would own. And we had all these processes for doing it, but what was missing was an understanding of what was really happening with the cash-on-cash returns of the business. And Joel, you really changed my mindset in a profound way. My career would never be the same without you.
Yeah, that was it. We took the time to build it. Look, we don't know what you knew about companies, or many of our institutional clients were not deep, super industry experts. Not that Rob doesn't have a lot of industry background expertise, but that wasn't it. It was like people don't take the time or have the time to comb through a 500-page financial statement and pick out every one of the notes to say, let's take the accounting and get back to something. And that's what we were providing to you at the time. I don't know, we became fast friends. I think it was every quarter I'd come in and just look at your look at ideas we had, meaning what are anything we're looking at that we think you might want to look at, and then you'd share your portfolio and you'd say, all right, what do we see in what you hold that we might find something interesting to share? And that was it every quarter, like Lob's type.
I mean, literally, you were one of our first clients. I mean, my God, it's been 15, 17 years at this point.
That's right. Wow. Right. And Valens, you were one of the very first.
Well, that's incredible. And I think as we're going to talk a little later about what makes great investors, and one of the things is they have a systematic plan, and yes. The tool you have today is now part of my systematic plan. So. Yes.
I love it. Well, it gets perfectly in the transition, because when we talked today about what we wanted to talk about, we said, you're so process focused and so thoughtful, and ever since we kind of started talking to you 17 years ago, that's been something that stood out. And when you think about what's important for an investor's process, the one thing that I think that I always hear from you is the word checklist. You want to give our viewers and everything an understanding of what that means and why that's so important?
Yeah, well, I mean, maybe it's better to say how I started, right? So I left, bright eyes right out of business school, and I'm like,
that was NYU. You went to RPI, so you already had a more scientific mindset, right? RPI and then Stern School of Business.
Right, yes. And then you
don't forget Dannon too.
Yep, you come out of business school and you think, well, I understand competitive advantage, and I'm just gonna I'm just gonna figure it out. My big brain, my wisdom, I'll just figure it out. And after working with literally hundreds of investors, with talking with all the greatest, I heard one thing in common with every single one of them. And what that was is they all had a process or plan that they followed. And they answered a few questions first in order to build that, but every single person I talked to had one.
And I mean, if you think about that in terms of what would you say your checklist is in your process, and what do you think is the way to get there?
Yeah. I think you first have to ask yourself a few questions. And so I don't want anyone to copy my process, right? Because my process is specific to what I believe. So the first is understand what your biases are, question one. Question two is you have to understand where you're really good at something. There may be things, today in my job where I'm more macro generated, I try and blend the macro with the micro to make decisions. I'm pretty good at that, but the micro is no longer my specialty. I don't have thousands of investors working for me. And then the last thing that I'm pretty good about is leaning against the crowd, right? And that feels easy for me. Most people, that makes them uncomfortable.
That means you're a contrarian.
That's right.
At Yard, yeah.
Yep. And so those are the things that I'm good at. And so when I built the checklist, it's really about making sure those biases don't, or those things I have don't take me off the wrong road.
Your personal.
My
So that
personal
means
ones.
You don't say, here's the investment checklist, and Rob and I should go adopt it.
100%.
Because my checklist should be specific to my biases, how I think to get me to the end goal of being in the market, right? And you're saying your checklist has to be specific to you. This is very interesting because a lot of people say, this is how you should be running money and this is a template for it and do it the way, whatever, versus no, it has to fit who you are.
Well, to your point, Joel, I mean, right, when you think about the checklist manifesto, that seems to be what the checklist manifesto says, but really it's not what the checklist manifesto.
Well, the checklist manifesto, I know you love that book, Atul Gawande, and
You gave it to me, by the way. Thank you. Yeah, you did, right? So that's how I started with it.
But it fit what you talked about all the time, which was checklists. And so he said that he noticed that, in fact, it was the most intelligent people that would find checklists to be pedantic, right? And so they were the hardest people to get to use it because they're like, oh, I know what to do already. And so he used the doctors all the time, right? He said, in doctors that use checklists, you have so many less problems, less malpractice, less whatever. Well, why wouldn't it work? And then it works with planes, airplanes, and aviation use checklists. So why wouldn't investors use checklists versus, oh no, I just know what to buy. I just do it by my gut feel or whatever you people say, especially during bull markets.
Yeah. No.
During bull markets, it's like, I just know what to do, right? Suddenly there's no checklist.
And I think the personalization is really important. And maybe this is a good indication that I'm just not that smart because it felt natural to me. But where the checklists really matter is when you're working with other people, right?
Yes.
So who are your advisors? Who's helping you, right? Whether it be a subscription service or whether it be the sell side, you need to understand where they fit into the process. So I really focus on four things. Yeah. The first is, to me at least, price matters most, right? Yes. So that's going to be universal if you listen to Munger and Buffett, people like that.
How much are you paying for that stock?
Exactly.
Right, yes.
Yep. Or the asset or the idea.
Sure.
The next question that matters to me a lot is incentives dictate behavior. And I watched a video from Charlie Munger 20 years ago at Harvard University. And he went through 25 human biases. He starts with incentives dictate behavior. And then at the end of the video, he goes on a 15-minute rant saying, I wish I had told myself that incentives dictate behavior more than I thought. And so I'm always underestimating that, right? The third thing is what you and I talked about up front and what you helped me think about is that you really can't make returns over a long period of time unless the cash on cash returns, the ROIC or the economic PE is in your favor. And so we could necessarily get into
Which means calculate correctly.
Correct.
Which means being able to rip through 400 pages of financials.
Right. You could never do that on your own, right?
Yes.
Or if you could, you need to be more disciplined than I am, and that's what I like about your checklist used to get that. And then the last one is probably the hardest. You really have to say, what do I know and what am I good at? And really on the other things, you need to work with either indexes or other advisors to get you to that position.
Well, I think that, right, to break down what you're saying, hey, Dave, your process would be buy something at a good price, make sure that management is aligned with what I want them to be aligned with, and then make sure that they actually have a really good, solid business with good economic moats, strong cash-on-cash returns, and then make sure that I actually can understand the business to understand what it changes. And I think that that's so often what a lot of investors struggle with is what they do is they get really good at doing this with one kind of company, and then they go, well, then I can do this with any kind of company, and that's that blind spot, right?
Yep. I think there's another blind spot. We were talking about where we were going to go to dinner tonight, and this is so this concept of an informational cascade, which is as humans we like to copy other humans, That's what kept us safe years ago. And so if we go out in the streets of Boston tonight and we're looking for a restaurant, let's say we did work ahead of time, we did analytical work, and we decided this was the best restaurant. If we go to that restaurant and there's no one in it, guess what? We don't want to eat there.
Yeah.
But if we go across the street and there's a what's that Italian place? If there's a really long line in front of that Italian place in the North End, we think it's a better place to eat.
Yep.
That may be a great way to pick restaurants.
Yes.
It's not a good way to pick your securities. You should do your own analytical work, all the things Buffett and Carl Icahn talk about, so that you are confident about the decisions you're making.
And I'll tell you, Schrager would tell you, no, they really are full because they're the best restaurant in the North End.
Yeah, exactly.
But so, like when we were talking about this, you kind of had an idea of there was one person, well, let's say two, Buffett and Munger, that you were like, I think that I've mastered what their checklist probably is. You want to take everybody through it?
Yeah. I mean, I did. I wrote it down, so just to, so I can cheat a little bit here. First, he's got a lot about price matters most, right? And then he has this cheeky line that I'd rather buy a good business at a fair price. That's baloney. He wants to buy a good business at a ridiculously fair price, a ridiculously good price for him.
1 foot hurdle.
Yeah, and he doesn't say, he uses the word incentives to dictate behavior. He uses the word, I want people I trust inside of that business. The one thing he focuses a lot on, what I think is the hardest to do, and we can see this empirically, Joel, I know you've studied this, is that you need to know when to pounce, really when it's on your side. So he knew, during the great financial crisis, that while he had never owned Goldman Sachs, that when Goldman Sachs gave an offer, a guaranteed preferred note at 11 or 12% yield in the middle of financial crisis, that was the time to pounce on financials. And so if you've got a process, you've got an approach, and then opportunity comes, you have to have the confidence to lean in, whether it be at the industry level or the market level.
Yeah, so you have to trust your checklist along with having a checklist.
I think that's it.
What I found interesting from the first days that I worked with you is, and I mentioned earlier that you'd say, what are the ideas we're seeing that for whatever reason you haven't?
Yep.
And then in the portfolio you already own, you said, tell me something I don't know about my names.
Yeah.
Right? No, I want to hear a rundown of every company. Pick out whichever names where you say you have something different. And I think this is an important point because any good checklist should make sure what you are doing, and you've said it a few times, is blind spots. Yeah. You're seeking disconfirming evidence. That's right. You're saying, I think these are my best 50 ideas, but tell me if I'm wrong. Right? And one of the things that we as a team, that Rob and the investment team put together that I got to present to you was, you own these 5 names, and of the 50, we might swap these 5 for these 5, and here's why. You get the same exposure, and here are the reasons. And that's a lot, because you're saying, tell me where I'm wrong. Yeah. As part of your seek disconfirming evidence. And a lot of people, I would say most investors, I'll say even money managers, most financial advisors, they seek data that supports their opinion. They're not going out saying, tell me where I'm wrong, tell me where I'm wrong. Even on your investment committee, right, with our investment committee, Rob is pushing people to play devil's advocate.
Yeah.
Right? Someone has to tell us where we might be wrong so that we don't have that blind spot because of those biases, right?
It's a great idea. It's a great idea. We when we were running, large pots of money, and we worried about that exact bias, which is your confirmation bias.
Yes.
And then you seek availability, you seek data that supports it. And so we had an assigned devil's advocate.
A critical negative.
The critical negative person,
right.
And just so I didn't have to always be the Debbie Downer, I would make a different person be the devil's advocate.
And you tell them they have to do it. Because if you don't tell them they have to do it,
they're
going to be afraid. They'll be like, oh, all right, this is all right. Dave's already thought of this.
Yeah.
And that guy will pick on me when I have my stock pick that I have. So I don't want to actually pick on his stock pick
but you're
because
told
that's
you
stepping
have to
over.
be the bad guy. Then they'll do it and not feel like, oh, am I going to hurt someone's feelings?
And I'll be honest, these were competitive.
Yeah.
Nuggets. So most of these people had no problem with it.
Right.
The other thing we worked on a lot, and I thought if I listened to the folks, Stanley Druckenmiller is big on this. When you listen to Stanley Druckenmiller, what he talks about over and over again is how he's willing to change his mind. And he'll be on national TV and say, well, this is what I believe this quarter, but I may change my mind.
Yeah.
And so he's realized how hard it is to change your mind. And what we did on my team is we desensitized to the words I was wrong. And just being able to say that out loud in front of a large group was hard to do.
Yeah.
Right? So, there are a lot of tricks to understanding how you can get your story-driven mind to work well analytically. Let's say more like Spock and less like Captain Kirk. There are a lot of ways you can do it, but there's no one path.
Yeah, yeah.
That actually gets to a good new topic kind of to get to, because you're kind of leading me there. When you think, you spent many, many years in institutional land, what do you think are some of the biases that are sitting in institutional investors' minds that they don't realize that cause them to frequently underperform the market or cause them to not always be on the right side for investors?
Yeah. The list is really long, and just to frame who I'm thinking about, I worked everyone for the largest endowments in the world, Saudi Aramco, CPP, down to retail investors, and here are a few things. The one is that everyone seeks, when they're looking at bonds, they seek the highest yield they can find.
Yep.
And when we study that empirically, it's actually a really dumb idea, right? In fact, what you should do is look for securities that are well priced but not exceptionally well priced. So the higher yield tends to underperform. Look, in the middle of a recession, sure, buy high yield.
Yeah.
But the other 9 years, if there's one bad year and 9 good ones, you want to be buying securities yielding yet. So that's a mistake I see quite often.
Yeah.
The other mistake is the one everyone knows, but they don't seem to be able to do anything about it. And I think Charlie Munger said, I just try and be greedy when everyone else is fearful.
Yeah.
Right?
Yeah.
And I got to meet Charlie, and I said, "What?"
Well, that was over a proxy thing, right?
Yeah.
That was your,
Yeah, but I said, that doesn't mean no good. How do I actually do that, right, was my question to him next. And
how do you be greedy when others, like, how do you even know that,
How do you actually, when the whole world is moving out, and that's why I always say price matters most.
Yes.
Right? If you can buy a great business at 10 times free cash flow, that's generating 15, 20% returns, you may lose money in the short run, but you make money over the long.
Yeah.
And so being aware when those opportunities jump in front of you, you have to say yes.
Well, I think to your point, part of the reason why it's so hard for institutional investors to be contrarians, to your point, is it comes back to the idea of incentives dictate behavior.
Yeah.
One of the things that I always love that you would always say is whenever, we or anybody else who I'd sit in a conversation with you would be like, I want to start a new fund, and you'd be like, cool, go talk to all of the asset managers in 5 to 10 years when you have a 5 to 10 year track record that you've actually beat the market, because that's the only way they're going to give you money. And it behooves you, if that is your incentive, if your incentive to get money, the behavior it's trying to get is be just like the market but a little better for 10 years, it's impossible to get those people to be contrarian. They're always trying to be just fast followers, right?
Yeah. And one of the things I worry about with Twitter and some of the people being very popular giving thin tweet advice is they're trying to be right 100% of the time.
Yeah.
First of all, that's impossible.
Yeah.
If they were really that good, they'd be billionaires, right? If you got 10 stocks in a row right, you're a billionaire, right? You wouldn't be doing FinTwit. So I think what we need to understand is even a great advisor is going to be wrong 40% of the time.
Yes.
It's the risk adjusted, and they're willing to work with you to make those said decisions. And so I do worry about that. I also, notice that it's, when there's fear, uncertainty, doubt, it's easier to scare people out of their positions and elsewise. JP Morgan just studied this. In the last 9 years, retail investors have consistently pulled money out at the bottom of the market and put money in at the top of the market. And so they're lagging the market by 500 basis points a year, just because of the fear-driven,
This is one of the things I've heard from our mutual fund investor clients.
Yep.
That they said, the problem I have is when I'm dying to buy stocks, my retail clients are pulling the money out in their 401ks and everything. And I'm like, but this is when I should be buying at the bottom of 2009.
Right.
Or even the back end of 2009 or even early 2010, they're like, I want to be buying, but I have no money because I'm getting redeemed every day still. And then at the top of the market where they're like, I think the market's toppy, and yet I just got another $1 billion of new investments that I have to place, and I have no choice. And he goes, so I'm being forced, even against my own will, somewhat, as a mutual fund manager, because you're dependent on the money coming in and out from all the retail investors to do what they're saying. And that's one of the sources, I think, sometimes of mutual funds that underperform the market, is even they're saying, I'm not being able to buy when I want, I'm being forced to sell when I don't want.
Yeah, I think we also have to keep in mind, both of you have used a vocabulary, a soundbite, something like this, but Wall Street is not in the business to make you money.
Yeah.
They're in the business to make themselves money. And the only thing they can sell to you are things you already Pavlovian believe in.
Yes.
Right? So, selling the NASDAQ when it's on a 52-week low is hard. Selling the NASDAQ when it's on a 52-week high, maybe yesterday, when it's going up and to the right, is easy. So they're leaning into what you already want to buy. And you do have to be careful with that as an investor because that framing matters.
Yeah.
Well, I'd be careful with anything Wall Street says. All
Yeah,
the time.
I know you are. I know you are.
Especially Wall Street analysts, Wall Street research,
Why is
investment
that?
bankers.
Why should we be cautious of Wall Street analysts?
Because they're not there to make money for their for investors that are hearing their calls, right? When's the last time you paid for, right, hearing that Goldman Sachs was a buy or a sell, or any one of the big banks?
Yeah.
Right? It's given away free to the media, right? And one of the top analysts said to me, we were just talking about this, one of the top 3 rated analysts in investment banking at the time, one of the top 5 banks in the world, and he was like, this isn't equity research, this is equity journalism. I'm here to write about the companies that are true clients and get them attention in the right way. And so that's why I'm 19 out of 20 buy and hold.
That's right.
Out of 20 stocks he's covering, 19 were buy and hold. 1 was a sell. And when I said the 1 was a sell, and he said, I'm going to have to add 2 more sells. And I said, how are you going to, because the bank was saying you can't have 19 out of 20, you've got to have a few more sells. I said, so which companies are you going to pick to say you've been covering for 10 years, buy and hold, and make them sells? He goes, no, I'm going to add coverage. I'm going to add 2 more companies that we don't do any banking business with, and those would be my sells. So that was a very candid, honest thing. He was like, of course I'm not going to jeopardize my 19. I'm just going to expand coverage.
Yeah.
Right?
Well, and just incentives dictate behavior. The clients of the bank are not individual investors reading the research notes. The clients of the bank are the potential M&A business or merchant banking or whatever that might be.
That's where the fees are.
That's right.
Meanwhile, you get Bloomberg and CNBC and all these stations just parroting whatever the bank analysts are saying, like it's gold, never thinking that 95% of buy and hold, right, of all stock recommendations are buy and hold, not sell. And they're like, and they talk about at least a big deal. Oh, they've got a strong buy on this. I'm like, they got a strong buy on everything, right? They got a buy and hold on this. Of course they do, right? Because it's the client of the bank. Yeah. And yet this, what we call the Wall Street media industrial complex is so woven in. And so when you're in that echo chamber and you're hearing it from the news sources, you're hearing from Wall Street, you're hearing from whatever else, it's hard to not follow the herd, right, as a retail investor, which is, I think, one of the big reasons why you said retail investors underperform even just the plain S&P. Yeah.
And I mean, so Dave, right, we talked about for institutional investors, right, what their biases are inherently. It's if you want to accumulate assets, which they're all in the fee accumulation, asset accumulation business, that is. And we talked about Wall Street's biases. You've also spent 35 years talking to individual investors, big asset allocators. You talked about one of the blind spots that they have, right? Chasing yield, and how that is truly a blind spot. You don't chase yield when yield is tight. Are there any other biases that you think investors, those investors have that you you noticed and picked up on in your time in BNY?
Yeah, I think the easiest one to fix, right, is just to, we all have advisors, right, when you're making financial decisions. It could be an investment bank, it could be your spouse, it could be your next door neighbor that happened to get the last 5 stocks right, so you want to buy the 6th one from him or her.
Which will almost certainly go down.
Them. You may, but those are all people part of your circle, and I think each time you should ask simple question, 2 quick questions, and this is first is what are their financial motives of working with you, and that usually most people get right, but you really have to a lot of questions to get to what a Wall Street's incentives are. But the second question needs to be, other than that, what might be their incentives? And so let's take, for example, one of the large money center banks. Let's say you're working with a private wealth firm. Goldman Sachs, I'm not picking on any one of them, they're all the same. Yep. What they're most worried about is they'll lose you as a client. So if they recommend an idea that goes bad, it's on them. If they recommend an idea that everyone already agrees with, let's say NVIDIA, and it goes bad, that's okay, they lost in a crowd. And they would rather lose in a crowd than lose alone. And that may not be with the best investment ideas. And both Buffett, Munger, Stanley Druckenmiller, Carl Icahn, they all say you need to go where the crowd isn't. And the Wall Street banks are going exactly where the crowd is.
This is where the no one gets in trouble buying IBM. This is 40 years ago, right? Yep. Right. Even if IBM isn't the best equipment, even if it's terribly priced, even if you're paying too much, even if it breaks down more often than their competitors, but you won't get fired because, you bought IBM, right? Well, people think that way about stocks. Yeah?
They do, especially in the advisory business. So those are the things I've been focused on.
No, that's great. And I think it's really important for people to think about. And part of just everybody, why we wanted to have this conversation with Dave is because his years of experience here in this, we hope that you can already hear and you've been listening and thinking, oh, those have been blind spots that I've had in my investing. Or like, Dave, I even think about that last one. The inverse is true also. Your financial advisor, because the fact they don't want to lose you as a client, also if you bring an idea to them, the probability that they will say no to that idea that you pitched them that you want to put your money in, why? Because if they say yes, that was your idea, I just made sure that they weren't going to rob you. But if they say no and it goes up, you're going to fault them for forever. It's that same it's that same idea.
right.
Because of our biases of, right, loss aversion hurts more than, so.
Yeah, and that is I've worked with some really great clients, and the really great clients start with, what do you think of this idea? Rather than I already like it, right? Because if you went to if you go to a car dealership and you tell him you want a red station wagon, guess what? He's going to show you 2 red station wagons and 1 bad white one, and you're going to choose from the 2 red ones. So that's how human beings work, right? Daniel Kahneman wrote a whole book on this, Nudge, and he got a Nobel laureate for it. But the people selling to you understand this.
Yep, and I love that too because it was actually one of our former colleagues who was big in bonds, Matt, would always say whenever he wanted to trade a bond or a CDS or something else in the market, he would always call up the broker and be like, just give me the bid ask. And the broker would be like, oh, are you on the buy side or sell side? And he goes, I don't know yet. Give me the bid ask.
Clever, right? Yeah.
But I think that covers the kind of the biases. Since Dave, I know you do also, Joel, always love hearing just how you think about the world in general. So before we wrap up, I have 2 more questions for you. The one is, what is the macro thing going on right now that you think people aren't talking about that has you the most excited or bullish?
Yeah, I mean, I think there's 2. On the bullish side, I think this AI thing is real. I think the problem with it is the vast majority of where the market's focus is building these big AI data centers that are basically filled with semiconductor chips, undifferentiated, they're NVIDIAs or AMDs, and air conditioning systems, and then some hollow fiber walls. So I'm not very excited about that. There's not a scarcity of that. There's tons of real estate. Where we are short is power. And in the United States, the easiest power to get up from ground zero would be natural gas. We are the cheapest producer in the world. And if we went to rest of world pricing, that means if we exported our natural gas through LNG ships, we can move the price threefold, from $3.50 a BTU up to 11 or 12 a BTU. And then, we listen to Trump, and Trump wants a balanced trade. I don't think he'd be fully successful, but if he's partially successful, this is one of the goods we're the world's cheapest at that we could give to the rest of the world. So it would balance our trade.
And we have so much also in the ground that we haven't punched holes in to pull out, or that we've put caps on after punching holes, that we could even bring the price of the rest of the world down to 7 and us up from 3.5, and we could still actually bring on more capacity and online and everything else.
We'd still be in it. And then the best thing too, what's been killing this trade is how successful the Permian oil drillers were. Because when you drill for Permian oil, you get natural gas for free. We call that associated gas. Well, now that oil has fallen from 90-ish to low 70s, 60s, that means the Permian oil drilling stopped. So that'll naturally squeeze up the price of natural gas. It's come in a little bit with this recent uncertainty. I think your best asymmetry, right? So limited chance of loss, biggest chance would be the natural gas producers. I won't give individual security names here, but there's a few of them in that list. I think the safer play, and maybe not as much juice on the upside, would clearly be some of the infrastructure plays, MLP plays here in the United States. They look attractive to me. You guys have written about them, make a ton of sense.
No, I mean, to your point, we like a little bit of both. So we think those both make
conviction list, right?
Yep, exactly. For both natural gas and for MLPs.
Can you say that, Joel?
Oh yeah, I mean, we'll tell you one. I mean, just to your point on the actual natural gas side, we'll give one. We actually have several, but I mean, Texas Pacific, if you want to talk about it. It's not directly
TPL?
natural gas, TPL, but Dave, the whole entire point is it's a phenomenal company because if we need, first off, if we produce more natural gas or oil, right, they just take a VIG. They don't have to do it. They don't have to do anything as royalty. Second, if we actually start thinking about the idea of, wait a second, if we have to build all of these just training facilities for AI in terms of data centers, and we want to also build power plants next to them, whether it's firstly a lot of cheap land, in West Texas. Do you know there's also, to your point, a lot of basically gas for free, West Texas? Do you know where we can also run, basically do whatever we want from a regulatory perspective, from running power wires and anything else? West Texas, there's this little embedded thing there that it's like, natural gas is the heart of it, but natural gas is the kernel, that there could be so much more for TPL and a couple of these other companies, which is really interesting.
Yeah, look, that makes a ton of sense to me. I'm gonna look at it tomorrow. So thanks for that.
I'm sure you actually already know about Texas Pacific, Dave. Let's be honest.
The thing that I would worry about, and this is one of those things, the problem for the markets are not one-off things. It's something that the entire market believes is true. It just isn't quite true, right? So if we go back to the housing crisis, the belief was that we could never have a national housing crisis. We did.
Yes.
And so, there's a belief that the Federal Reserve.
Oh, you like that term. What's that term? The shared.
The shared fictions.
Shared fictions. Yeah, I got that from you. I love that.
All right. So the concept of a shared fiction is we all believe in the same story together, but it happens to be fictional, right? Greek mythology is a shared fiction. We all believe that we could control the weather through sacrifices. So it's potentially a shared fiction that central banks, particularly the G7 central banks, can control yields at any rate they want. And we've been doing pretty well for 40-odd years. And interest rates have been falling for 40-odd years. It looks to me that 40-year trend is over. And if you look at the US 10-year, the Japanese 10-year, the German 10-year, all of those are higher. And that is the key risk-setting rate, discount rate for everything in the world.
Yes,
Besides the fact that, apartments and all higher yields.
Cost of capital brings down valuations, all other things being equal.
That's right. That's right. And so we're on the precipice here as we meet with the 30-year over 5 for the first time in 20 or 30 odd years. The 10-year is right at a level. Japan is a level I think they haven't seen in 4 or 5 decades. So we're clearly hitting a point at which we're going to test that universal shared belief that we can control yields. And I do hope we can control them a little bit, but I think investors should prepare for higher rates over the next decade than we have now.
That's your point. Maybe bond vigilantes cannot totally blow up the 30-year and the 10-year U.S. Treasury. We could maybe keep it in a channel that's in the 4s to 5s. However, the idea that we're ever going to get back to 0 to 2 to 3 or even below is probably gone, is your point.
There we go. There we go. And you guys have done all this great work on the weighted average cost of capital and how to discount securities. And in fact, basically Joel wrote the book on this years ago on how to do that. And so it matters a lot. It matters a lot. And so this is particularly true with long duration assets. So if you're buying a company trading at 100 times earnings, what matters is a discount rate matters a lot more than an MLP where it cash flows every year. And so what we do know is that when rates rise and go up over time, it's generally the highest multiple stocks that struggle a little bit, and that's the area I would be most worried.
Or also say venture capital, the only non-institutional asset class there is, had a great 40 years to not be an institutional asset class. Maybe they're going to have to get some religion to possibly have an asset class here.
Yes, and I meet with hundreds of venture capital managers, and I would say some understand it's changed, but the vast majority of them just show you the last 20 years of returns and say, look how good we did, it's going to be good the next 20. And I'm more skeptical on that call.
Right, and when we talk about, just to be clear everybody, when we talk about Palantir venture capital being, I just pick on Palantir because you said 100 times PE and they're probably like 1,000 times PE. Right, because the idea of long duration assets is assets that you're going to have to wait for all of the cash flows to possibly get to you
affected
by interest rates. Yeah.
There we go.
Dave.
Yeah.
Thank you so much as always. It's always a pleasure to talk to you, man.
God,
so
it's
thank
great.
you so much.
See you, friends. Thank you.
Absolutely.
Thank you, sir.
Thank you, guys.
And thank everybody. Thank you so much for tuning in.
Thank you.
Until next time. All right, thanks everybody for tuning in. If you want to hear more and follow us on a daily basis, just click the first link below and be able to track what we're doing every single day.